welcome to the program. Look, SPACs.
Thanks so much.
Bloomberg is estimating the space is now worth $156 billion. What do you make of this wave of SPACs coming to market?
Look, it definitely seems to be a feature of 2021. Look, they're really interesting structures. There's a lot to say for them. They kind of make sense for the people investing because they generally invest, and then they have their par value of cash shells, and they get to they really make sense for the company because the company can just kind of go to market really quickly without going through the very arduous IPO process. And it's quite likely that all the best companies in the next 1, 2, 3 years come to market this way. The downside, of course, is these companies don't go through that arduous IPO process. They don't. There's so many rules and regulations that apply to IPOs that don't apply to SPACs. So the most obvious one, or the most relevant one, is probably the ability to forecast. So if you read these SPAC presentations, they're often forecasting revenues at 80 to 100% growth rates, 5 years in advance. Then they'll compare their 5-year, internally forecasted growth multiple compared to, what the market might be estimating for a far more mature company. And because they don't go through that IPO process, they don't need to go through investment bank DD in the same way, due diligence in the same way. It's just kind of like a merger agreement. The bar to doing this is much lower. So you've kind of got this space where all the best companies are probably going to come to market this way because it's so much better for kind of the company doing it. They have so much more control over how it happens. But at the same time, there'll be a lot of junk out there. And you're seeing a lot of things like, flying car companies that might have revenues in the next 5 years, coming to market via SPAC, putting out extremely aggressive, optimistic forecasts, and then getting multi-billion-dollar valuations. There's electric car companies that, have not built a car yet. They're doing something similar. So I think it's one of those markets where there's going to be a huge range of outcomes. And there's no doubt that, it was red hot in the first part of this year, kind of peaking in February. It was at the point where these cash shells with $10 per share were actually trading at significant premiums, like 30, 40% premiums to cash, which obviously shouldn't really happen. Just in the prospect of a deal might happening. Like, it was really that red hot. It sucked in a lot of money. And a lot of, I guess, new investors are now sitting on very serious mark-to-market losses. So they're kind of the views on the space. It's a mixed bag. There's a lot of good things about them, but like a lot of these financial products, there's something like very good at the start, but then, gives way and allows people to kind of take advantage of that. So they're kind of...
Michael, from the moment into the office this morning to coming into the studio, there was 6 SPAC listings that came across my terminal alone. That's 6. What do we say in an environment where people are throwing money at investments where they don't actually know what they're buying? They're buying a pledge, a promise to go and find a company to go and fulfill these prospects. It comes across to me as being very late cycle and very much like a process to go and allow early investors to go and offload and crystallize their gains before the market turns. What's your sense?
Yeah, look, there's 2 parts. I mean, there's definitely a way for insiders to offload stakes at fairly aggressive valuations. People who invest in these SPACs actually do know what they're buying. They're putting $10 in, they're getting $10 of cash. Often there's options on that, warrants. So if a deal goes ahead, they'll get additional upside to that. So that's kind of the pitch to the people actually funding these SPACs. It's like, give us, $10. We'll put the $10 in a bank account. You'll get some upside optionality. And if you don't like the deal we do, we'll give you the cash back. So that's kind of like why these things are happening. You can almost see how appealing it is at every stage of the deal cycle, but also see how, in an environment like we're just in, that can be really taken to excess. And because people are buying things, not necessarily for financial reasons, just because the deal kind of makes sense, that means people do deals that they wouldn't do otherwise. And there's probably going to be a lot of money lost in this sector, as well as a lot of money made.
So that is one hallmark of where we find ourselves in this cycle. The other is that we're seeing this rotation from growth into more cyclical names. The NASDAQ down, officially into correction territory once again today. So what are the hallmarks of what you're seeing right now in the market? Can we look to history to give us any indication as to where we're potentially at in that sell-off and where we could end up?
Yeah, I mean, there's been a couple of these recently. Generally, they've been pretty good buying opportunities. The most recent one before this, where rising rates caused a pretty severe sell-off, was in 2018. It almost echoes a lot to this one. The difference then was that, the Federal Reserve was raising rates. This time it's been market driven. The Federal Reserve has actually been quite, has effectively kept the base interest rate pretty low. What happened then, there was a big kind of sell-off, and then like a 1-2 month recovery, and then a final kind of purge at the bottom. And that high to low was about over 20%. I think it was 22, 23 in the NASDAQ. But there's two things there. It was over really quickly. It was over, within a couple of months after that. And really the opportunity to buy stocks at that low were fleeting. And that triggered effectively a bull market up until where we are today. And that's kind of what's happened here. You've seen this initial purge. NASDAQ's down 12%, stocks, many high-flying tech stocks are down 20, 30, 40%. But really the multiples are down a lot more because we're kind of in 1Q 2021. If you look at kind of calendar 2021 multiples, often the multiples are down 40, 50, 60%. And that means you're kind of like getting to these like valuation low, not necessarily valuation lows, you're getting to this valuation point where it could really set you up nicely for the next 1, 2, and 3 years. And so if you think about like 28 as a guide, there could be like another 1 to 2 months and probably lower lows as rates rise. Before that, you kind of have to go back to say 2016 where there was something similar. But that was a different beast. I mean, then absolute valuations were much lower. The falls were much lower. Now you're coming to a point where, there's companies trading at 50 to 100 times sales. I think certain sectors are going to get hit really hard. So I remember there was a solar boom and crash many years ago, which I vividly remember, where all the solar companies lost, 80, 90% of their value, but then became one of the best investments ever. So I think, and that's kind of happened over, those kind of companies have kind of peaked. There's a lot of intense interest in the SPAC land, which we're just talking about. So the SPAC sucked in a lot of fresh capital into new electric vehicles, new battery companies, all kinds of companies forecasting revenue in 2025 and beyond, their first revenue in 2025 and beyond. So I think that sector is probably going to come under a lot of pressure. And weirdly, one of my sectors, so life sciences, another one of my sectors is kind of diagnostics and tools. So we've been a beneficiary of this, but there's been a couple of buyers, ARC most notably comes to mind, who poured, billions and billions of dollars of stocks into very small companies. And those companies went up to 50 to 100 times sales over the last kind of year. And I think that sector is probably also going to come under pressure. So if you've got a company growing at 30 to 40%, it may be the best thing in the world. If it's trading at 50 times sales, there's really a long way down. Where we tried to manage that on the way up. So we cut renewables to, about 3% of the portfolio. Had we let those things run, it would have been, 15, 20. Similarly in not life sciences, similarly in software, that became a very, very small part of our portfolio. So we're already looking at opportunities to kind of add those back. Because, the 3-year and 5-year stories are still there. You just need to make sure that you're buying at appropriate value points on an absolute basis. So that's kind of how we're seeing it. Like these rising rates are kind of knocking a lot of things down. Whenever these things happen, there'll be amazing opportunities. But there's still plenty of risk out there.